Bueno, buenos días a todos y muchas gracias por estar aquí. Damos también la
Morning, everyone, and thank you very much for being here. And we welcome all the people that are following us through streaming. First of all, I would like to thank you for being here with us today. The truth is that the title of the presentation is a topic that we are seeing that is awakening a lot of interest among our investors. At Schroder's, we don't think that this is new. This fund was launched in 2007 with the same philosophy and the same manager, so we've been doing this for several years already. And what makes us different is that we are looking for companies that try to adapt and mitigate climate change. So this is not just a green fund that only invests in renewables, but a fund that analyzes where the impact is going to be and who are the winners in each of those sectors. In order to do that, we have Simon Weber, who is the manager of the fund since its inception. And the idea is just to give you a very visual presentation of what are the effects in the world of climate change and what are the opportunities that are given to us by this new trend after governments have decided to do something about that and are trying to mitigate this global warming thing. And so I turn the floor over to Simon. You have the headsets for translation. If you want to listen to simultaneous interpreting, you can ask questions at any point in time in Spanish if you like, but you have to wait for a microphone so that the translator can translate that for Simon in English. Okay, so Simon.
Good morning, everybody. Thank you very much for coming, and it's certainly a pleasure to be here. I'd look forward to as much dialogue and in this session. So I will not talk for too long, but if there are things as we're going through, also please feel free to raise your hand. This issue, this subject, is a passion of mine, and I've been lucky enough to be responsible for leading this climate change strategy at Schroder's for the last 12 years. And I think it's fair to say I've never seen as much interest or potential in the theme as there is today. And hopefully in this presentation, I'll give you some reasons why. And I'm going to start off with a little bit of background on climate change and then take you through the investment themes and the investment opportunities that we see as the world gets to grips with this huge challenge that we all face. I'd like to begin with a little bit of background on the terminology and the basics of climate change. And we often talk about temperature increases, but what is that with respect to? So when people talk about 2 degrees of warming in the Paris Agreement, that is with reference to this pre-industrial baseline, which was set by scientists before 1850, before essentially we had a lot of transport and power generation that used fossil fuels. So this is the baseline that we talk about for greenhouse gases and for temperature increases. And where are we today? Well, today we have already warmed on average in the world by 1 degree relative to that pre-industrial baseline. And we also have another 0.5 degree in the works. So this is because the greenhouse gases already released, carbon dioxide, methane, and other gases. They have they stay in the atmosphere for quite a long time, and they have this amount of warming that's already stored up. So this is what we know is already likely to happen. And so any actions that we take from now on are about reducing the future warming that that would come. And hopefully, as you can see from this image, the joy or the sense of achievement that leaders had when they actually managed to agree a global deal in Paris in 2015. It was a deal that required countries to submit their own individual action plans, but it set an objective of keeping global temperature increases below 2 degrees. So just another half degree above what is already baked in. And so much of the climate policy being developed now by countries around the world is to try and play their part in achieving the Paris goal. So much of what we do at Schroders and on the climate change investment team is trying to think, well, what does achieving or striving to achieve the Paris Agreement really mean? To what extent do emissions need to be reduced, and what does that mean for different parts of the economy and the investment opportunities that come from it? And one of the tools that we've developed at Schroders to help us with this, and it's not just for the climate change strategy, many of our clients find this very useful. It's a model that we update every 3 months, and it is seeking to track progress towards the Paris Agreement. Now, what we do is we take 4 areas: political change, business and finance, technology, and entrenched industry. And for each of these areas, we track three major fields. And we've created a trajectory or a mapping for what each of those need to do in order for us to be successful achieving the Paris Agreement. So, for example, oil and gas investment. This is looking at the capital expenditure plans of every company in the oil and gas industry that we can find. And to cut a long story short, achieving the Paris Agreement essentially means reducing that capital investment towards zero over 3 or 4 decades. So that's the path that we map, and then we measure how far off of that trajectory is oil and gas industry investment today. And rather depressingly, we're still, this is the most off-track area, and there's still far too much investment going into those industries if we're to meet the Paris goals. The more optimistic ones are things like renewables, where although we're not investing in renewables at a rate that would get us to the 2-degree goal, we're much closer. And interestingly, public concern. I mean, I think we've seen that in the recent European elections where Green parties made significant gains. But probably most notable, we've seen it in America, where over the last 18 months there's been a major shift in public opinion. There's still a bedrock of hard skeptics on climate change, but I think the natural disasters that America has experienced over the last couple of years have really begun to raise concern. So that's quite an interesting development for us to monitor with regard to American politics. So we update this every 3 months, and the 2 that ticked up in the last 3 months were this public concern and carbon prices. And I'll come back to European carbon prices, but that has been one of the other positive developments in the last 12 months. Has been a really big increase in carbon prices that creates the incentive for companies to invest much more in low emission technologies and energy efficiency. So at the moment, we're well off track, and what that tells us as investors is, if the world gets properly serious about dealing with climate change, we will have some big inflection points in these areas ahead of us. Now, I won't spend much time on this, but I think it is worth just covering why this is all important. Why are we even trying to keep temperature increases to 2 degrees? And at 2 degrees, there are still some pretty unpleasant consequences. The Greenland ice sheet may begin to melt irreversibly. Water availability in this part of the world is coming under pressure. But as we get up to 3 degrees, the scientific models tell us that many more people will go hungry, a lot more disruption of agriculture, crop yields, much more significant sea level rise begins to take place. And then these scenarios of 4 degrees, so remember our model suggests we're tracking towards this scenario at the moment. You get much more severe water stresses in some parts of the world. We get a lot more coastal flooding. It's already beginning to happen in places like Florida, Miami, Bangladesh. Many coastal cities at 4 or 5 degrees will ultimately have to be relocated or seriously defended. So, the world will not be a very nice place to live. I won't even spend much time on 5 degrees. But I think many people, and certainly many military organizations, think that there will be a lot of conflict in the world if climate change is allowed to reach these proportions. So, in our view, as long-term investors, either the transformation that we're going to have to meet the Paris goals and avoid dangerous climate change will be very significant, or the consequences of not achieving those goals will be very significant. And as investors, we need to spend time understanding those. So a little bit on what does achieving the Paris goal of 2 degrees actually mean. And in simple terms, over the next 3 decades, it means that every person on the planet needs to reduce their emissions by 80%. At a global economic level, slightly less than that to account for population growth. But after 2050, it still needs to trend down towards zero. So we're not talking about building a few wind and solar farms around the planet. We're talking about really taking emissions out of every major end market or every source of emissions. And so we can turn our attention now to where those come from and what that might mean. So here we've just got a simple look at the sources of greenhouse gas emissions. And a lot of attention does get given, understandably, to here, electricity and heat production. But this is only a quarter of the problem. We have heavy industry, we have another category, transportation and logistics. And until recently, almost no attention was given to agriculture, forestry, and land use in many climate change policies. I think that debate is rapidly changing. I'm sure many of you have become aware of the plant-based protein and veganism. As much as 25% of US and UK people who are under 18 to 25 would describe themselves as vegan or vegetarian today. And one of the reasons this has really come up onto the public debate is that livestock itself accounts for around 15% of global emissions, as much as transportation. So all the attention being given to electrified vehicles, there are some big other sources out here that will need to be addressed. We can come back to some examples of what this means. So ultimately, radical transformation in every sector. I'm now just going to be quiet for a minute while we play a little video that gives a taster of some of the products and the technologies that we're excited about within this theme, and then I'll go into those in a bit more detail.
Combating global climate change over the next 20 years needs a unique investment viewpoint. At Schroder's, we capture the most advanced environment-driven companies who are shaping a low-emission economy. For example, clean energy from solar and wind technologies has already become the most cost-efficient form of power in many parts of the world. New homes are being built from sustainable, energy-efficient materials, and demand and response power technologies are fast becoming a reality. More affordable, reliable electric vehicles have meant advancements in public transport and goods delivery, all leading to cleaner and congestion-free cities. New world companies are fast developing concepts such as plant-based foods, precision farming technology, and reverse vending recycling schemes. Industry is adopting processes to eliminate carbon emissions, and consumers are embracing products and services with strong environmental credentials. The technologies are already here. They'll continue to reshape our environment to combat climate change. And with change comes opportunity. Start your climate change investment journey with Schroder's today.
Just before I go on, just a short plug for the website, which unfortunately has disappeared, but it's a new website that we've launched this year, Schroder's Climate Change Investing. And it's a place where we're putting a lot of the thought leadership articles that the team writes and issues, information around the fund and the theme. So certainly if you have more interest after today, I'd encourage you to try out that website. But now maybe to build on a few of the ideas covered in that video, you can see on this slide 5 major investment themes: clean energy, sustainable transport, environmental resources, low carbon leaders, and energy efficiency. And these are the 5 main sub-themes that we think describe the growth and the investment opportunity associated with climate change. So I'm just going to give a few examples of each of them. And you can see within each theme we have a number of subcategories. I think one of the things I'd highlight as the most exciting today is to do with renewables. Solar power was, actually along with Germany, Spain was one of the countries that first began to subsidize and really push solar power. But it did come at quite a cost to both of those, to any country that had early subsidy programs, because it was expensive. And today, what this chart shows is the cost of solar power over the last 8 years or so, 10 years. And you can see how dramatically the cost of installing new solar power has fallen. And over the last couple of years, it's fallen below the cost of nuclear, coal, and gas. So the cost of new build solar is lower. And that means from now on, every time that we add solar to the grid, it acts as a deflationary force. And that's a much different political impact and social impact than when subsidizing renewables was essentially a cost to energy consumers, and that hits the lowest income households the hardest. So renewables are becoming a lot easier for governments to support. And we have examples now, places like Denmark, where renewables are well over half of all power generated. We're also becoming more comfortable that renewables can be a much bigger part of generation without causing problems. So we're incredibly positive on solar that it can stand on its own 2 feet and is very commercially viable. The same can be said for wind. In fact, wind energy crossed over earlier than solar. It's now being caught up by solar, but you can see really for years now, wind has been competitive. And this is onshore wind, but offshore wind is also maturing with bigger, better, more efficient turbines. And that's really allowing an expansion of wind energy too. So wind and solar are actually very good complements. And although we haven't always, as you might be maybe a bit surprising, in the Climate Change Fund, we haven't always had a lot of exposure to renewable energy, because there have been some periods where these stocks have been expensive or the industries had overcapacity. But today, we would say that these industries have consolidated, they've got very competitive technology, and are therefore much more attractive. The sustainable transport theme, in our view, this should include things like bus and rail networks, which are very efficient networks for moving people and goods around the world. But the biggest growth opportunity is really in electrifying vehicles. And this goes for commercial vehicles as well as passenger vehicles. And it's a similar story to solar, really, is that in the last 5-6 years or so, the cost of battery storage has fallen dramatically. It's been coming down about 15% a year. And within 2 years or so, on our models, the total cost of ownership of buying an electric vehicle will be below that of a combustion engine vehicle. You also have regulations. So the city of Amsterdam, for example, has a new policy of banning any combustion engine vehicle from 2030 onwards. But as a consumer, you will begin to think very hard about what you buy, what car you buy if you're going to hold that vehicle for several years. And there's lots of examples of that, certainly around Europe. So in our view, electric vehicles will be very powerful growth products. They're good quality and they're affordable now. And although many of the supply chain, or many of the companies that are supplying these newer technologies are actually based in Asia, Europe does have some leaders, and one of the companies we really like here is Umicore, a Belgian chemistry specialist, and they have the market-leading position of cathodes, which is one of the key components within the battery, where there's a lot of research and development and intellectual property. Another idea on this theme is a company called Chroma. It's quite a small company based in Taiwan, and they make testing machines. So every battery that comes off a new production line needs to be tested for quality and safety and reliability. And as a result, they're seeing a booming business as these new production lines are built out for testing machines. So, there's a whole new supply chain being created around electric vehicles, and that's one of the most exciting growth areas in our view. And then environmental resources. I mentioned a bit about agriculture earlier, but in our view, forestry is also quite underappreciated. Clearly, forests are one of the big, deforestation is a big source of emissions, but forests are a massive store of carbon, and reforestation schemes are certainly increasingly a part of countries' plans to become net carbon zero. I'm sure you're aware of some of Theresa May's problems as Prime Minister with Brexit. The last thing she's actually doing before leaving office is introducing legislation that will give the UK a legal requirement to achieve net carbon zero by 2050. And that does involve quite a lot of reforestation programs and will require giving a value to forests. Otherwise it won't be achieved. Forests also have fantastic properties. Wood is a brilliant insulator, it's a renewable resource, and this company, Sumitomo Forestry, they own their own timberlands. It's a Japanese company. They own their own timberlands and they use that wood to develop low energy housing. In fact, they're even making mini skyscrapers out of wood in Japan these days, believe it or not, despite having one of the toughest earthquake building codes in the world. And water is going to be a huge issue. We've seen that in places like California and parts of Africa already. And agriculture is the biggest consumer of water. There will need to be a lot more efficiency in the use of water by farmers. And so things like precision irrigation tools. This is an American company called Lindsay Corp who specialize in that. And that's been one of the long-term holdings in the fund. So we think there will be a lot of investment in agricultural productivity, but also water infrastructure as societies just become much more focused on avoiding leaks and preserving the water that we do have. I think this is one of the most interesting categories of low-carbon leaders. Now, achieving essentially net zero or 80% reductions in greenhouse gases does require all industries to change. And regulations, carbon taxes are likely to be introduced in most industries. So one of the things we do is we look across the economy, looking for industries where we can find a company that has innovation, it maybe has a production process that is different and much lower emission, that can make it stand out and essentially be a leader in helping that industry transition to a low-carbon future. And here's one example, a company called Schroder. They're a chemical manufacturer that supplies ingredients mainly to the consumer industry, skincare and cosmetics. And they have been able to develop essentially a refinery that uses bio feedstocks instead of petrochemicals. And that means they're able to supply a much more sustainable set of products to their customers who can then offer sustainable consumer products to all of us. And there's huge growth in demand for those kind of products. And I'll come back to another example later on in the presentation in the low carbon leaders. Maybe counterintuitively, some of the biggest opportunities we see would be in heavy industry where the change will be difficult. So any company that really can stand out and have a low emission production process, that will become increasingly valuable. This theme, energy efficiency, is quite a broad one. It will include things like insulation, housing, efficient heating, commercial manufacturing efficiency. And the company I've chosen to highlight here is a British company called Spirax-Sarco. All they really do is they specialize in the use of steam within manufacturing. And steam is a fantastic heat exchanger. It's very efficient. And so they go into manufacturers, they redesign the production process and provide energy savings to those customers. And as a result, they're seeing really good demand for their services. So those are a few examples of companies and themes that we're excited about. As I said, I've got a few more later on. But I wanted to just come back to some high-level numbers. Just how big will how much money is required to make this transition. So the 2 trillion per annum number here is not ours. It's supported by UN, International Energy Agency. This is a ballpark estimate of how much a year needs to be invested globally in clean, low-emission technologies to make this kind of transition. The figure on the right here of 15%, this is our number, and it's based on a model that we've produced that looks at much more detail than carbon footprints. It looks at the profitability at risk from companies as really assets become stranded or as carbon taxes and carbon prices go up to the level that is necessary to achieve the Paris Agreement. So this essentially 15% of earnings is our view of how big the earnings at risk is in companies in affected industries negatively. So really there's an investment opportunity on the upside, but there's also a lot of risk for investors who are not thinking about the risks of the investments that they may have on the other side of it. And so, putting those numbers together, $2 trillion per annum, over a decade, it's the size of the entire US economy needs to be invested in these kinds of cleaner technologies. And 15% of global equity markets is equivalent of the Russian economy today as well, potentially being at risk. So whether or not you're invested in a climate change portfolio or climate change theme, we just think that this issue is something that you should be paying attention to. So a little bit now on how we do this, our investment process. How do we identify those winners and losers? And this theme or this strategy is a collaboration between our sustainable investment team at Schroders, which has 15 members of it today. We take 2 people from that sustainable investment team, including our head of sustainable research, and they join several colleagues that I have on the global investment team, and we form the climate change team unit. So that means it's truly a partnership where, as we're deciding the investment universe, we have a lot of input from our sustainable investment analyst colleagues. So you can see here, I'm part of this global equity team. We have 8 global analysts or global sector specialists and several portfolio managers working with me. But the most kind of focused analysts on industrials, utilities, and energy join me on the team, along with these 2 analysts from the sustainable investment team. We then draw upon the resources, the broader resources at Schroders. We have 90 analysts around the world in different investment offices, and we have a team of data scientists in London who are essentially doing modern primary research with surveys, statistics, and big data analysis. So all of those analysts really helping us with our investment decision making. Now, one of the most important things is how we define our investment universe. And that we start with only listed companies, so we don't invest privately in this fund. We start with any listed company over $200 million in market value. And we have one exclusion criteria, which is fossil fuels. So we don't invest in any company that has significant reserves or more than 5% of revenues coming from coal, oil, or gas. So any company covered by that would be excluded. But the rest of the process is an inclusionary factor. So we will only bring companies into our investable universe if we've been able to identify a way in which climate change has a significant positive impact on the business. So you won't find us investing in companies where we think it's neutral. So as a result, there are not many pharmaceutical companies or telecom companies. We just don't think the impacts a materially positive or negative there. It will only be companies where we think climate change is a positive impact on the business. And we look at these range of factors, the exposure of the industry, and it might be very easy to include a company in an industry like renewable energy. In some sectors like the automotive industry is much more challenged by climate change, but there will be some winners and some losers. So we very much look at the business as it looks today, and then we look at what we think the business will look like in the future. And where a company, how much it's been investing, for how long it's been investing in these kinds of technologies will really have a bearing on how that company evolves and grows and looks. So we try and look to the future, not just how the company looks today, but obviously the product portfolio that they do have is essential to that. So I know that that maybe isn't giving a huge number of kind of rules that define our universe, but it really is the case in our view that every industry is different. In some we can include most companies, in some we need to identify the winners and losers, and those winners and losers may change because companies don't stand still. And the result of that process gets us to our 5 main investment themes. 95% of the companies we invest in will be within one of these 5 major themes. And today we have around 600 companies in the climate change universe. It's been worked on and built up a lot over the last 12 years. It's been as high as 700, and over the last couple of years we have taken some companies out. So that gives us the universe, and so everything in there we believe is a kind of positive play on climate change. We then have a pretty traditional investment process, but one in which a full assessment of E, S and G risks and opportunities is incorporated into our investment decision making. We have this concept of a growth gap, and that growth gap is where we expect a company to grow faster than the market is expecting. Those kind of companies will have positive earnings revisions and they tend to outperform. And one thing that's very important in a fund like this, where we will invest in a big global company and a small early stage startup, is the risk profile of those stocks. So we have an internal framework where we score all sorts of measures like balance sheet risk, operating leverage, management, and ESG. And that risk profile is central to how we size the positions in the portfolio. I'm happy to talk more about that later on. And that investment process gets us to between 40 and 70 ideas, so roughly 10% of the investment universe. It's very bottom-up, only and unconstrained to the benchmark, but it's a high-conviction bottom-up process. Once we have the portfolio, the turnover is quite low. We have an average holding period of about 4 years in the portfolio, so we're able to be very engaged with the companies we invest in. So we take our stewardship responsibilities very seriously. We have a number of targeted engagements going on at any one time with specific climate change, specifically with respect to climate change. And that there will be a number of more general engagements that Schroder's is doing across the company. But with one of the impacts we think we can have with this fund is really pushing some of our holdings to be more ambitious or pushing for more disclosure, that kind of thing. So towards the end here, I wanted to give a few examples of companies, maybe 2 of them less obvious examples, where we think climate change will really come to be a positive for the investment case. And the first one is a company called Norsk Hydro. They're an aluminium producer, so this is right at the front end of greenhouse gas emissions. The aluminium industry is very emission intensive, but Norsk Hydro have their production is all based in Scandinavia, Norway, using hydropower to power their smelters. And the emission profile that they have is around a third of most of the production, which today is in China, but any production around the world that's coal-based will have an emission profile that's around as much as 20 tons of carbon dioxide per ton of aluminium produced, 15 to 20. So Norsk Hydro has about a 10-ton advantage in terms of emissions to the high end of the cost curve. And in today's European carbon price, that advantage is worth about 250 euros, 10 times the 25 euro carbon price. And that's more than 10% of today's price of aluminium. So even at a relatively modest carbon price, in our view and our long-term modelling, carbon price will end up around 100. That's the level we think is necessary to create sufficient change. And at 100, that 10-ton advantage that Norsk Hydro have is worth about half the aluminium price. And I think it's a really good example of how, as carbon taxes or carbon prices get introduced by policymakers, it will really change the cost curves of some industries, and it will really change competitive advantages. And whereas today they're an efficient producer, but until carbon gets valued by society and gets introduced into the equation, it's not worth so much to Norsk Hydro, but it will become a much more valuable asset to them in the future. And now Amazon. So this little video is courtesy of Amazon, and one of their ideas for the future of this little electric robot that will go around neighborhoods delivering their parcels. And I don't know whether this little idea will end up in reality. But the point of showing it is that when we think about e-commerce, there are a couple of advantages that e-commerce has over traditional retail. Firstly, the warehouses that e-commerce operations operate are much more efficient. You have a few of them around the country, and you don't have all of these very expensively heated, air-conditioned, well-lit retail stores. So the direct emissions that come from e-commerce are much lower. And secondly, if you can get a dense delivery network and you can deliver to multiple households, then you also have a much more efficient logistics than people getting in their cars and going to the shops. So in our research of the academic evidence, it's already a small advantage today in average emissions that e-commerce has over traditional retail. But that is going to change a lot in the future. And so you can see up here in the top right, this year Amazon were able to come out with a target that by 2030, half of all their global shipments will be net zero carbon. It's a hugely ambitious target, and it will only be achievable if their partners in delivery networks reduce their emissions. And to that effect, we've been doing quite a lot of research with those companies this year. One good example is DHL, who in Germany and the Benelux region are expecting to be 100% electrified, or either bikes or electric vehicles for their last mile by 2025. So 6 years' time. So in 6 years' time, if you order an Amazon parcel and DHL deliver it, it'll be as close to net zero carbon as you're able to get. And so this is, I think, a good example of how there's where industries are today and there's where industries will be in the future, because although I'm incredibly positive about electric vehicles, even with quite rapid adoption of electric vehicles in new car sales, most of us will still be driving combustion engines for a long time because the fleet takes a long time to turn over. These commercial delivery networks, which are perfect for electrification because you can charge them up every night back at the depot, they will turn over and they will electrify much quicker. There's one other important part of Amazon, which is cloud computing, Amazon Web Services. And there, I think for many businesses like ours at Schroder's, it's a really interesting proposition, because when you move to the cloud, you get much higher utilization of servers. And Google Cloud, Amazon Web Services are building renewable energy to power their data centers. So there, within 2 years, Amazon will be 100% renewable, and Google already there. So you get emission-free enterprise computing, which is becoming very helpful for a lot of businesses to meet their own targets. Okay, I think we've covered that. The last example is a more straightforward one of Estas, and I mentioned earlier that we're a lot more positive on renewable energy than we were, say, 5 or 6 years ago. And the reason being that these technologies have matured, they've consolidated, and along with Siemens Gamesa, Vestas is one of our biggest holdings. And I just wanted to kind of put this in perspective. This is the worldwide installed capacity of renewable energy today at just under 600 gigawatts, and Vestas are the largest player. The annual installation run rate today of wind and solar is around 150 gigawatts. So it has grown a lot. But in our modelling, the rate at which we need to be building renewables to decarbonise power generation over the next 20 years is more than double that. So achieving the Paris Agreement probably will require a doubling of today's size of the renewable energy industry, and that bodes very well for companies like Siemens Gamesa and Vestas. So just to kind of nearly finish off a little bit about the fund itself, I apologise if it's hard to read these numbers from the back, but this is the fund's performance on the top. We use as a reference benchmark the MSCI World. There are, I will say, a number of structural differences to the MSCI World Index, but over the cycle we believe they will even out. So our target and the whole point of a thematic fund, in our view, should be that it's a good theme, it's outperforming, so we want to be measured against global equities. And we also, Morningstar put us in the ecology peer group, and you can see the quartile ranking has been very strong over most time periods against that peer group. In the life of the fund, I'd say the performance has really improved in the last 3 years. The financial crisis was pretty difficult for a lot of renewable and industrial industries. But you can see here over the last 3 years, really, I think the maturing of many of these technologies has helped these industries and the fund with it. And then the last thing I was going to show you was, this is those 5 themes within the fund. This image shows it in 2016, and I'd highlight that then just under half of the portfolio was in energy efficiency. That was a period of time when electric vehicles were not nearly as ready as they are today. Renewable energy was suffering overcapacity. So we had smaller investments in those sub-themes. And then I'm just going to click through the quarters. You can see how over the most recent quarters, as we've become more positive on renewables, electric vehicles, there has been quite a big shift towards those sub-themes. And we funded that largely from the energy efficiency investments we had. So to summarize, we obviously believe this theme is a very powerful, long-lasting one, a source of alpha generation because it's quite poorly understood. But it's also a very exciting time. We have kind of global agreements, and we have a lot of political change that on balance is moving in favor of more action. We have technologies that are becoming commercially available now. We don't have all of them yet, but we have a lot of them. And we have quite a big upswing in consumer interest and consumer demand, and investor interest and investor demand. And as a result of that, the business world is responding. Lots of investment by companies, and lots of pressure from shareholders. So industry is adopting these technologies. And as a result, we think that economic transformation is increasingly starting to happen, and it's a very exciting time to be investing in it. So with that, I hope I've posed a few questions, or there's some things to discuss, and be happy if we have time.
Thank you very much, Simon. No sé si tienen alguna pregunta. Sí.
Are there any questions? I would like to thank you for sharing your views with us today. I wanted to ask, in terms of fixed income or equity, what is the makeup of your portfolio, or do you have anything about derivatives, currencies, and so on, in order to understand the configuration of the fund?
Okay. I have a couple of appendix slides that will help a little bit, I hope. So firstly, it's an equity-only portfolio. We do have quite a lot of product development underway at Schroder, so I think you'll see more from us in the fixed income world, and we have a number of very interesting multi-asset products as well. But this strategy is a long-only equity fund. You can see here by geography, we're really quite underweight North America, and that has been a headwind to performance over the last 5-6 years. There are just a lot more companies doing a lot with climate technologies in Europe and Asia. So we quite structurally underweight North America and overweight Europe and Japan. And then in terms of sectors, you can see industrials here is by far the biggest exposure we have, but we also have quite a lot of investments in technology, materials, consumer cyclicals. So we're underweight defensives, and that's certainly something to bear in mind, that the volatility of the portfolio is above average. But it is a portfolio that will do very well when an investment upturn, and certainly with government policies to drive infrastructure spending into these newer technologies.
Y teniendo en cuenta que es un fondo.
Bearing in mind that it is an equity fund, what do you think would be the performance of the fund in times of global economic recession?
It's a tricky answer, and I forgot to say we don't do derivatives in the fund, and we don't hedge currencies in the portfolio. There is a hedged share class, so there's a euro hedge share class for people who would wish for that. So the experience we've had with it is that in the global financial crisis, which was obviously a serious recession, the portfolio underperformed, and it performed very well out of that recession. Interestingly, in the fourth quarter of 2018, when there was a lot of worries about global growth slowdown, the portfolio actually performed quite well. And that was driven by, even though a lot of industrials underperformed, the kind of industrials we hold are things like Vestas, Siemens Gamesa, some solar companies, energy efficiency products. And these are proving a lot more resilient because the industrial weakness or the investment weakness is coming in areas that we need to be moving away from into this direction. So it's my view that the theme is beginning to become more resilient. However, it is still a cyclical portfolio, and we should expect a global growth downturn, or if there's an all-out trade war, that will not be that helpful for this portfolio.
Good morning. Thank you very much, Simon, for your presentation. It has been very interesting. I think. Okay. Thank you very much, Simon. This is a very interesting presentation. I think my question is a little bit easier to answer compared with the previous one, but it's related as well to the yields and returns. Okay. We as potential sustainable investors, do we expect to sacrifice some kind or some spread on return for the investment? And if so, for how long? Thank you.
I don't think it's that much easier. I mean, not in my view. My view is I understand the academic theory that whenever you narrow the opportunity set, you will somehow sacrifice, returns. But, in my view, we still have a very big opportunity set. If you have the right theme, then, and I believe there will be a lot of investment going towards these areas, then unless the stocks are starting from an overvalued starting point, then they should be performing very well. I don't think you can say the same for every theme. Not every theme will be, one that drives performance. But when you narrow the opportunity set in an intentional way, in my view, that doesn't need to sacrifice performance. And, taking it as a more ESG type of question, in my career, I've just seen so many examples where bad governance or companies that take risks with their workforce or the environment, it comes back to bite them and they end up being terrible performers. So in my view, having a high bar, a high threshold for the quality of environmental, social, and governance practice by a company is not something that should mean we expect to sacrifice performance. What I would say is that valuations are important, and there has definitely, in the time we've been running the fund, there was a first phase where renewable energy became very hot, and there were a few renewable energy funds, lots of money went into them, there were not very many companies, and those companies became very expensive. And then you're set up for bad returns. And I think one has to be quite careful of that. It's why we like having a broad investment universe, and I think it's my job to, when we feel that companies become overvalued, to just sell them and look for other ideas. The best example of that I've got at the moment is a company called Beyond Meat. I don't know if you've been following the IPO of a few weeks ago, but it's a really interesting company with a burger that basically tastes exactly like a burger, but it's made from plants. And they're sold out in all the shops in Germany and the UK. Restaurant chains want to offer this burger. And so it's a really hot IPO, and it's gone up 7 times in 2 weeks. It's trading on 20 times sales, and this is a food company that should make 10% margins, and it's going to have a lot of competition from Nestle and Unilever coming. So even though we participated in the IPO, we thought the stock price could double, and we sold it when it doubled, and I now feel quite stupid. But I think it's really important to have a valuation discipline, and those kind of periods where you have a narrow theme and too much money goes into it is where one needs to be careful.
Simon, good morning. I'll try to make myself clear, if I can. I find it difficult to understand why your proposal as a fund manager of not investing in a company that has more than for example, you said a minute ago, 5% in solid fuel and so on. Why your decision is the best one? Mm-hmm. And maybe another fund manager says, no, we'll go up to 10% because we have to give them time. So when are we going to have a really equal benchmark for all fund managers in ESG and environmental investment, so we can have a clear idea of how the industry is doing this in inversions and these investments and these developments and these, you know what I mean?
Yeah.
I really find it difficult to explain to my clients who is doing it well, who is analyzing. I know it's a bottom-up analysis, and really your internal analysis is very, very, very strong. But how can we compare? And I know it's cruel, but we need to do so.
Yes. Well,
thank you.
Thanks for the question. I think I understand that we don't make it that easy for you as an industry, but I don't have an easy solution because while there are a number of standards and labels being developed, the European Union is developing one. In my view, that looks like a very restrictive label that may have an unintended consequence of driving money into just a few stocks. So we would then have a clearer set of standards, but they may not be as well performing, and they may suffer this problem of just funneling too much money into a few stocks. These are the holdings of the fund, but I wanted to give you one example. We want to be as transparent as possible, and the reason that we have a 5% limit is we think that cuts out any company with significant fossil fuel revenue. The one company that we have, if we reduce that to 1% or 2%, the one company that we hold that would cover is in here in environmental resources called Weyerhaeuser. And they're the biggest timberland owner in the United States. And in my view, it's an absolutely fantastic company for a climate change portfolio because they manage their timberlands very sustainably, and these are the kind of assets that we should be supporting investing in. But they do, landowners and timberland companies, they develop certain properties for either residential use and building, or and they also sell mineral rights. So on their timberlands, there are 1 or 2 mines, and there's a little bit of extraction for which they get a royalty of fossil fuels. So that is a company that has 2% or so of revenues coming from fossil fuels. Now, I'm very open to debate, and certain standards. If we're forced to sell that company, we would. But in my view, that would be counterproductive, and it's exactly the kind of company we should be investing in, because forestry needs to be recognised and grown, and the large part of what they do is incredibly positive for the environment. So our approach is to try and be transparent. We're doing that through reporting as well, and I know you can't read this, I'm afraid, but anyone who's interested, we could send you these reports. The first one here, this is an ESG report where there's a range of environmental, social, and governance indicators that are based on third-party data, and it compares our fund to the benchmark. And because this is a climate change fund, we've developed, green because it's the environment, we've developed an expanded list of climate indicators. So this is the carbon footprint, the fossil fuel exposure, MSCI's environmental score, exposure to environmental revenues, as many verifiable indicators as we can show. And so our attempt to deal with this problem is to be as transparent as we can.
Thank you very much for the presentation. I was wondering if you could share with us a little bit how is the internal debate that you hold within Schroders when you have this global investment committee that you mentioned. I wonder how much influential are you being to the other teams at Schroders? How much of your ideas are populating the global portfolios or European portfolios? So, are you able to persuade other managers to hold the same climate change opportunities that you hold in your portfolio? And for instance, a practical question will be, does it mean that generally at Schroders, equity portfolios are light of solid fuel companies and overweight in renewables? Thank you.
Okay. It wouldn't be correct to say that, to generalize and say that across Schroders, every portfolio, or even most portfolios, I'm not sure exactly what the average is at the moment. So in individual investment teams, in our emerging markets, European investment team, they have their own process. But we share meetings, we share information, we share reports, and we discuss a lot. And the work that we do on the climate change team is absolutely shared, and we think is helpful for other portfolios and other investment teams. So this, these is showing you the current climate change team. Andrew Howard and Mark Hassler are our members from the sustainable investment team. And they have a quality, in terms of our investment universe, they have a quality control role to make sure that nothing goes into the universe unless they approve of it. So it's kind of, fund manager can't have his favorite idea and put it into the universe. And the work, the research that we do on this team, I'm a part of this broader global equity team, and our portfolios are absolutely consistent with this thinking. So the Schroder Global Equity Fund, the International Equity Fund, we're underweight. We don't own zero, but we're underweight the energy and fossil fuel sector. We have a number of the best ideas from this strategy are in our global equity portfolios as well. So it's not something that we just believe in for this fund. It's absolutely central to the work we do on the global team, where we try and bring the best ideas from. We have a couple of other thematic funds as well. We try and bring the best ideas up into the more general global equity funds.
Okay. Simon, I would like to close the event with one concern that some of our clients ask us when we speak about thematic funds. And they really understand the power of these themes on the long run, but the main concern is which is the theme that is going to play today, because at the end they invest today and not in 10 years. So would you define your fund as a global mega theme, let's say, where you rotate these sub-themes and take advantage of those that you see the value today? Because at the end there are too many and difficult to analyze and to put in a portfolio.
Yeah, okay. I wanted to just go back to show this, because I think it shows the balance of investments in the portfolio among these 5 sub-themes. And some people would probably, would identify each of these sub-themes as a thematic in its own right. And as I showed earlier, we're very active in where we invest the portfolio, wherever we see the best value at one period of time. So I hope that our kind of market positioning or our proposition is that we will be a more consistent performer for clients who want exposure to the long-term theme of climate change, across many different sub-themes. And there are other themes that we don't tackle, of course, but it is a very broad issue, and we think the investment implications are very broad across the market, and therefore we should be able to deliver a more consistent performance than a theme that is more narrow.
Okay, thank you. Pues nada más, solo darle las gracias una vez más.
Okay, so that's all. Thank you very much for your attendance, and any doubt that you may have, we are here for you to answer them if we can. Thank you.